Imagine two friends starting their money journey at the same time. One believes success comes from picking the perfect stocks. The other believes in something much simpler. Now, here's the big question. Who actually wins after 30 years? Most people think the smart, hardworking investor who studies companies will come out ahead. It sounds logical, right? But what if the truth is the complete opposite? What if doing less actually makes you more money? This is not just theory. This is real data, real behavior, and real results over decades. And by the end of this video, you might completely rethink how you invest your money. Because the biggest mistake many people make is not losing money, it's making less money than they could have. And the scary part, they don't even realize it. So stay with me, because what you're about to hear could change your financial future forever. Let's meet two people, Jake and Marcus. Both are 30 years old, both earn $75,000 a year. Both decide to invest $1,000 every month. Same income, same starting point, same goal, to retire comfortably. But their strategies are very different. Jake loves researching stocks. He spends hours every week reading news, watching videos, and analyzing companies. He buys popular companies like Apple, Microsoft, Tesla, and others he believes will grow fast. On the other hand, Marcus keeps things very simple. He doesn't pick stocks at all. Every month he buys one thing, an index fund that tracks the entire market. No research, no stress, just consistency. Now think about this. Who do you expect to win? The hardworking stock picker or the lazy investor? Most people would choose Jake, but this is where things get interesting. In the beginning, Jake feels like a genius. Some of his stocks go up fast. He sees 30%, 50%, even 80% gains on certain picks. He talks about it with friends, at work, and on social media. People are impressed. It looks like he knows what he's doing. Meanwhile, Marcus has nothing exciting to say. His investment just slowly goes up. No big wins, no stories, just steady growth. It feels boring. And here's the trap. Jake's wins are visible, but his losses are hidden. He doesn't talk about the stocks he sold at a loss. He forgets the ones that didn't work out. But Marcus, he owns everything, the winners and the losers. No guessing, no picking, just the whole market. Now, here's the question. Is excitement actually helping Jake, or is it secretly hurting him? There's something powerful happening in Jake's mind. It's called selective memory. He remembers his wins because they feel good, but he ignores his mistakes. This is something every human does. It's natural. But in investing, it's dangerous because it creates a false belief that you are doing better than you really are. Marcus doesn't have this problem. He has no stories to tell, no emotions tied to specific stocks, just numbers going up over time. And this difference may seem small, but over many years, it becomes massive. Now think about your own behavior. Have you ever talked more about your wins than your losses? That's exactly how most investors think. And this mindset is one of the biggest reasons people underperform the market. Now, here's where the real data comes in. A financial study looked at thousands of stocks over many years, and the results were shocking. More than half of all stocks performed worse than very safe government investments. That means most individual stocks are not great investments. Even more surprising, a very small number of stocks create almost all the gains in the market. Just a few big winners drive everything. Now think about that. If you don't own those few winners, your returns will suffer. But how do you know which ones they are? That's the problem. You don't. Nobody does. Not even professionals. Marcus solves this problem by owning everything. Jake tries to solve it by guessing. And over time, guessing becomes very expensive. Let's make this simple. Imagine there are 100 stocks in the market. Only 4 of them become huge winners. The 96 do average or poorly. If you pick stocks, you must choose the right 4 out of 100. That's very hard. But if you buy the whole market, you automatically own 100, including the winners. No effort needed. This is why index investing works so well. It removes the need to be right. You don't need to predict the future. You just need to stay invested. Now ask yourself, would you rather try to find a needle in a haystack or just buy the whole haystack? That one decision can change your entire financial life. But it gets even more serious. Professional investors, people who do this full time, often fail to beat the market. Studies show that most fund managers underperform over long periods. These are experts with teams, data, and years of experience, and still they lose to simple index funds. Now think about Jake. He's doing this part-time on weekends. If professionals struggle, what are his chances? This is not about intelligence, it's about probabilities. The system is designed in a way that makes it very hard to win by picking stocks, and yet many people still try. Why? Because it feels more exciting, but excitement does not equal results. Now let's talk about something most people ignore: taxes. Every time Jake buys and sells stocks, he may have to pay taxes on his profits. Even small trades can add up over time. This reduces how much money stays invested. Marcus, on the other hand, trades very little. His index fund is designed to be tax efficient. This means more of his money stays in the market, growing over time. And here's the key idea: small costs repeated over many years become huge losses. A little tax here, a small fee there, it all adds up. And most people don't notice because it happens slowly. There's also behavior. Jake reacts to news, emotions, and market changes. When stocks fall, he feels pressure. When they rise, he feels confident. This leads to mistakes: selling too early, holding too long, changing strategies. Marcus avoids most of this. He sticks to one simple plan: buy every month, no matter what. This removes emotion from the process. And in investing, controlling your behavior is often more important than picking the right stock. Now think about this. How many times have emotions affected your decisions? That's where most investors lose money. Let's look at the numbers over time. After 10 years, the difference between Jake and Marcus is small, maybe just a few $1,000s. Jake doesn't worry. Everything looks fine. But after 15 years, the gap grows bigger. After 20 years, it becomes serious. And after 30 years, the difference is massive: hundreds of thousands of dollars. And here's the shocking part: Jake never felt like he was losing. His account kept growing, but it was growing slower than Marcus's. And that's the hidden danger: losing quietly without noticing. This is how compounding works. Small differences become huge over time. A 2% difference per year may not seem like much, but over 30 years, it can mean hundreds of thousands of dollars. That's the power of long-term investing, and also the danger of small mistakes. Now ask yourself, are you focusing on short-term wins or long-term growth? Because the market rewards patience, not activity. After 30 years, both Jake and Marcus retire. Marcus has about $1.7 million. Jake has about $1.1 million. That's a difference of over $600,000. Imagine losing that amount without even realizing it. That's the cost of small mistakes repeated over time. And remember, Jake worked harder. He spent thousands of hours researching, but effort did not equal results. This is a hard truth for many people to accept. Now, some people will say, what if I pick the right stock? Yes, it's possible. If you bought a company like Apple early and held it for decades, you could make huge returns. But here's the problem: you must pick the right company at the right time and hold it through ups and downs. That's very difficult. Most people don't do it. They sell too early or panic during drops. There are also examples of companies that looked promising but failed. Many investors believed in them. They were popular, but they didn't deliver. This shows how unpredictable the market is. What looks obvious today may not work tomorrow. That's why relying on predictions is risky. Index investing removes this risk. You don't need to guess. You don't need to predict. You just follow the market. Over time, the market grows because businesses grow, and by owning everything, you capture that growth automatically. It's simple, but very powerful. But let's be fair. Index investing is not perfect. You own bad companies too. You don't beat the market, and it can feel boring. Some people want more control. That's okay. The key is balance. Use index funds for your main investments, and if you want, pick a few stocks for learning or fun. Here's a smart approach. Put most of your money, say 90%, into index funds. Use the remaining 10% to pick stocks. This way, your future is protected, but you still enjoy the process. You get the best of both worlds. Also, consider where you invest. Some accounts have tax advantages. Using them wisely can save you a lot of money. Many people ignore this and lose money unnecessarily. The biggest lesson here is simple. Investing does not need to be complicated. In fact, simple often works better. The market rewards discipline, patience, and consistency, not constant action. So what should you do? Start investing regularly. Keep costs low, avoid unnecessary trades, stay consistent, and focus on the long term. These simple steps can build real wealth over time. At the end of the day, the goal is not to beat everyone else. The goal is to build a secure future. And for most people, the simple path works best. Now think about your strategy. Are you making it harder than it needs to be?